Kapil and I am Ritu Singh. Now, Kotak Mahindra Bank has just reported its fourth quarter earnings today in its first full quarter under the new CEO, Ashok Vaswani. The bank's standalone profit rose by more than 18% year-on-year to 4,133 crores for the fourth quarter, beating street estimates. The net interest income, which is the core income of the bank, that came in at 6,909 crores, also above estimates, up about 13.2% over the previous year. The margins were flat sequentially, almost at 5.28%. Advances growth was strong of about 18%, and deposits nearly 24% growth over the previous year. Asset quality improved, with gross NPAs coming down to 1.39% and slippages at 1,305 crores, lower sequentially during the fourth quarter. Abhishek Kothari has been poring over the numbers for us and joins in with the fine print.
Well, Kotak Mahindra Bank has seen strong deposit growth. If you take a look at the YOY numbers, they are one of the best in 22 quarters, and sequential growth is one of the best in last 34 quarters. If you take a look at the peer comparison as well, sequential deposit growth amongst all the peers have been 6 to 10% on a range. If you take a look at SDFC Bank, ICICI Bank, Axis Bank, or as Kotak Bank. However, the net interest margin improvement is the highest for Kotak Mahindra Bank. So in terms of deposit momentum, it is up 23.65% YOY and about 9.9% sequentially. The CASA ratio has declined, and it's at 27 quarter low, coming in at 45.5%. Advances growth remained healthy at 17.6% YOY, which is one of the best in last 4 quarters. Sequential growth is about 4.5%. PNL, both the NI and PAT is a beat on our poll. They have a one-offs in their results, so they have an AIF provisions which has been written back of about 156 crores, and also they have written off 1,455 crore of retail unsecured gross NPLs. So that's helped the asset quality improve this time around. Slippages have come in at 1,300 crore. Morgan Stanley was estimating about 1,200 crore in this quarter. However, asset quality due to high write-offs has improved. Gross NPA ratio is down to 1.39% versus 1.73% in the previous quarter, and net NPA has remained flat on a sequential basis at 0.34%. In terms of key ratios, now net interest margin was expected to decline on a sequential basis by 5 basis points, but it improved by 6 basis points on a sequential basis. It has come in at 5.28% versus 5.22%. Cost to income ratio has seen massive improvement on a sequential basis. It's down to 44.8% versus 48.4% in the previous quarter. And thanks to that, they have seen an ROA of all-time high in terms of quarterly ROA. Back to you.
All right, thanks very much for bringing us those details. To further analyze Kotak Mahindra Bank's fourth quarter earnings, we have with us Binod Modi, Portfolio Manager at Sharekhan, who's joining us on the phone line for more. Binod, thanks very much for your time here on CNBC TV18. A quick takeaway from the fourth quarter numbers. Not much to complain about here in terms of the financials, Binod.
Yeah, in terms of number, it looks to be, significantly ahead of what was being anticipated by Street as well as, our in-house research. In terms of, deposit growth, almost 9% sequential growth looks to be, the best among all the banks whomsoever reported so far. And the most surprising part, I believe, the kind of improvement that we have seen in the NIM, unlike expectations of decline of 8 to 10 basis point, company reported in fact improvement in NIM. So I believe that's probably because of higher contribution from high yielding loan books that the company had been witnessing for last couple of quarters. So that could be one of the reasons. And yes, the asset quality and everything looks to be in a better side. ROA, almost 3% sort of ROA for the quarter. Definitely Street should be cheering these kind of numbers.
All right, Binod, do hold on. We also have market expert Prakash Diwan with us. Prakash, strong numbers from Kotak Mahindra Bank, especially on the deposit front, perhaps much better than some of its larger peers.
Yes, I do agree, but the big question is the stock going to respond to numbers that have been good for March, or are we still staring at a situation of uncertainty going forward? So I think that's the larger question plaguing the business and the bank and the stock. But yeah, I think if you look at the fine print, very decent growth, even in advances, which is quite surprising. I never thought they would. Personally, I was of the impression that they were holding back on credit growth, but that seems to have been fairly decent as
sure.
Along with
Prakash, My apologies. I have to cut you short. We have the new CEO, Ashok Vaswani, and the management addressing the media. So let's listen in.
Don't want to come up? Okay, first of all, thank you so much. I know it's a Saturday evening and you're sparing your Saturday evening to be with us. Is a big deal. So much appreciated. I thought we'd do three things today. The first thing, you've already seen our results. I would submit the Q4 and full year 24 has been a very good year for the group, and I would like Devang to walk us through the results and share that in more detail with you. The second thing I'd like to do is give you an update on the RBI order and deal with that. And thirdly, what I thought I'd do is I want to share some thoughts with you as to how I'm thinking about the Kotak Group and how we should be taking things forward. Having done that, we'll open it up for Q&A. We'll do, take any question that you want to kind of talk about. We do have a meeting with investor community after that, but we'll go right till then and try and answer every single question you have. So without further ado, let's start with the best news of the day, which is really the results. Okay. Devang.
Thank you, Ashok, and good afternoon, all of you, and welcome to this press conference. The results which you all have been adopted by the board in today morning board meeting, and I'll run you through the consolidated as well as the bank standalone results. Okay, so I'll start with the consolidated results. Consolidated PAT for the year is 18,213 crores, which is about 22% up on a YOY basis, and for the quarter we clocked 5,337 crores profit, which is up 17% on a YOY basis. So I think customer assets, which comprises of our advances and credit substitute at consolidated level, are 4,79,169 crores, up by about 22% YOY basis. The ROA, which is return on asset, for the quarter is 2.92, and for the year it is 2.62%. Capital adequacy continues to be healthy at 21.8%, with CET1 itself of about 20.7%. Book value per share is 653 rupees. ROE, which is based on the profit of quarter profit, is 16.85%, and on the year profit it is 15.08. Overall, the net worth of the group just under 1,30,000 crores, of which bank net worth is 96,700 crores. Given that headline, let me move to the bank standalone performance, which has shown a robust growth. The bank closed the year with a PAT of 13,782 crores, which is up 26% over the last year. And for the quarter, bank's PAT was 4,133 crores, which is up 38% on a QOQ basis. The quarter NIM stood at a healthy 5.28%, while at the full year NIM is 5.32%, which is same as almost the last year. Capital adequacy at the bank level is 20.6%, again with tier 1, which is the common equity for us, is 19.2%. Return on asset at the standalone, 2.97 on a quarter, and for the full year basis, it is 2.61%. Core fee, which is the core fee, includes the banking fees, the distribution fee, the syndication fee, shown a healthy growth of about 25% over the last year. Operating cost increased by about 21% on a YOY basis, and like to highlight, we continue to spend about 10% of our total operating costs towards the information technology cost. During the year, we added about 93 lakh customers, of which about 24 lakh customers were added in the last quarter. The quarter also, we had one non-recurring item, which we had a favorable order from income tax, which actually resulted in the tax rate for the last quarter lower than the earlier quarter. Gross NPA at 31st March, 1.39, as against 1.78% last year. Our net NPA continues to remain low at 0.34% as against 0.37% last year. Credit cost for the full year FY24 is 45 bips. SMA2 with a very, very small number of only around 200 crores for the bank. So that's the bank stand on the headline. Let me now go to the subsidiaries, which account for about 25% of our profits, overall consolidated profit. The capital market subsidiaries clearly benefited based on the increased market volume in the current year. The Kotak Security ended a PAT of 1,226 crores as against 865 crore, a growth of 42%. Kotak Capital, which is into investment banking, clocked a profit of 215 crores as against 150 crore last year with a growth of 44%. Kotak Investments, which is into lending, also clocked a profit of 514 crores as against 326 crore last year based on the book growth and the recoveries. BSS, which is our microfinance correspondent subsidiary, ended with a PAT of 383 crores as against profit of 297 crores last year. Kotak Prime, which is into car finance business, ended with a PAT of 888 crore compared to 829 crores. Last year, Kotak Prime had recoveries and certain bought out incomes, which resulted in a relatively lower growth in the performance. Both the NBFC, which is Kotak Prime as well as Kotak Investments, both are well capitalized and the capital adequacy is far in excess of 25%. Coming to the Kotak Life Insurance, I think the Kotak Life Insurance performance got impacted due to a higher commission payout and strain in our new business in non-par products and ended the year with a profit of 689 crores. Kotak Life's solvency continues to be healthy at 2.56 times as against the requirement of 1.5. The domestic mutual fund entities contributed 525 crore worth of profit as against 555 crore last year. Last year profit obviously included a one-time investment sale of 130 crore. So if you adjust for that, they've shown a growth of about 20%. So that's broadly the overall highlights of the consolidated standalone performance for the bank and the consolidated entity. Thank you.
Devang, thank you so much. A lot of numbers, but good set of numbers. So that's the good thing. So let's move to the second item on the agenda, which is really the RBI order and the impact of the RBI order. So as you know, on 24th of April, we received an order from the RBI directing us to do two things. Number one, stop onboarding of all new customers through our online and mobile banking channels. And two, stop issuing all fresh credit cards. So no new customers on credit cards. Now, needless to add, we take every communication from our regulator extremely seriously, and obviously therefore I've complied with the directions and I've stopped all new customer acquisition through digital channels and for new credit cards. Just to make it completely clear, there is absolutely no impact to an existing customer across any channel, any product that we have. So our existing customer base, absolutely no impact. We've been seeking guidance from our regulators on building resilience of our technology systems and on enhancing the experience of our customers. Personally, me and we as a company are totally committed towards building world-class technology infrastructure and giving customers the best-in-class customer experience. To meet the standards expected by our customers and guided by our regulators, we've been on a continuous upgradation journey for the past 2-3 years. We've made a number of senior hires, and we've talked about this in the past, significantly augmented the internal tech team and invested in capacity building towards risk and resilience. Devang just told you that our technology expense is running at about 10% of our total operating expense, and you can just see operating expenses have grown year on year on year. The proportion on technology is at 10, so we are significantly spending more on technology year on year on year. However, what is evident is that our efforts have fallen short of what the regulator expects. My commitment is that we will further accelerate our efforts and investments. Winning back the trust and reputation with our customers and regulators is our number one priority. Right? That's for me personally as well as the management team. We are, of course, in continuous dialogue with the RBI and are seeking their guidance in getting to the expected outcomes. Needless to say, we will keep you updated on those kind of developments. With that, if we could just kind of step away, just step back a little bit, right? I've been in the new role for about 4 months now, literally 4 months. So it's a little over 100 days, 120 days. And I just wanted to share with you how I'm thinking about things, to give you a sense of where I think Kotak could be going and what could be the continued growth path for Kotak. Obviously, we've spent a lot of time as a management team talking about these things. And while it may not be fleshed out in a great amount of detail, the direction that we are setting is pretty clear. So, you know, as you well know, I've worked in many parts of the world. And the one thing common about all the many parts of the world and India is that technology is changing every single business in every single geography. There's just no question about that. But I'm not talking so much about technology. What I'm talking about is the impact that the technology is having on the customer. How does the customer think about things today as opposed to the way he or she thought about things yesterday, right? In a way, if you really think about it, 30, 40, in the mid-70s, when television first came to India, it completely changed the way the Indian consumer thought. Because for the first time, there was a unifying experience across India. The internet happened in the mid-90s, close to 2000. But India in particular, and what is unique about India, which I have not seen in any other country, not the United States, not the UK, not Europe, not Asia, there are three factors at play which make things in India very different. The first factor at play is that the government and how the government has spent a lot of money on digital infrastructure. The kind of digital infrastructure that the government, the public sector has built is absolutely incredible. It is really quite amazing. I don't think there's anything like this anywhere else in the world. So the public sector and how they've kind of gone about doing this is one big thing. The second big thing is the cost of telephony and data in India is about the lowest compared to anywhere else in the world. This has been led by the private sector. What has therefore happened because of these two elements, one led by the public sector and one led by the private sector, the adoption of new technologies in India has been absolutely staggering. So these three things coming together have led to the customer thinking about things in a very different way. So the outlook of the customer, the exposure of the customer, the expectation of the customer, and the affluence of the customer. Outlook, exposure, expectation, and affluence of the customer has changed quite dramatically. And in everything that I have learned in my many years in business is that if you align your entire business model around the customer, you win. You get it right by the customer, everything else falls into place. If you get it wrong by the customer, whatever else you do fails. So when I'm thinking about Kotak and our management team sits down to think about Kotak going forward, we look at our entire business from four lenses. To keep it really, really simple, we call it the 4C framework, right? Starting with the customer, and I already talked to you about how the customer has changed, outlook, affluence, expectation and exposure, right? To the colleague. At the end of the day, the colleague is also a customer. And the colleague is also the one who delivers on the promise to the customer. And therefore, making sure that we have the right talent to be able to deliver on this promise is going to be very, very important as we go about of the transformation of the business. 3, of course, is company. So customer, colleague, company. In company, what we are really talking about in the Kotak Group is that we are financial conglomerate. We have businesses right from capital markets to microfinance to insurance to the bank. How do we bring all these businesses together to meet holistically, to meet the needs of the customer? 2, how do we have scale? And scale is not just for the sake of size. Scale to be relevant, to have a seat at the table, to be able to drive the development of the industry. And 3, anything that requires scale obviously requires technology. The 4th one is community. And this is very important. What do I mean by community? I mean at least 2 things. Number 1, the Kotak brand. What does the Kotak brand really stand for? How do we re-establish and reinforce the brand Kotak? And number 2, how do we build excellent relationships with all our regulators, obviously including the RBI. So as we are thinking about our business, we are saying we'll use the 4C framework: customer, colleague, company, community, and align the entire business model over delivering holistically for the customer. Now, having said that, the management team and I are exceedingly clear that our first priority, our first and top priority is to get Kotak back to business as usual. And while we are doing this, and in this period, while we are building everything that it takes to get Kotak back to business as usual, getting ready to come back roaring when we get the permission to do so from our regulators. With this, let me hand it back to Prasanna, who can then help us moderate the Q&A session. Thank you.
Thank you, Ashok. Now we'll open the floor for questions. We have a few colleagues out there with microphones. Just a raise of hands and we'll come to you one by one. Like I mentioned earlier, we also have our media friends joining us virtually. What I'd urge you to do is try and restrict your questions to 1 each. We'll come back to you for multiple questions as we get more time. Right.
Hi, this is from ET now. While congratulations everyone for the wonderful results, but I guess you would appreciate the curiosity regarding few of the announcements which has come in the recent past. First one being regarding the Reserve Bank of India's recent embargo. I want to understand what is the material impact which you would have assessed by your own. Is there going to be any? And also, once you cannot issue credit cards, which are the other areas of growth which you are focusing? I understand credit card is a very minute portfolio part of your bank, but overall, have you strategized on your part how you are going to go ahead for minimizing the impact of Reserve Bank of India and how you will look after growth?
So let me try and take that. First of all, thank you. Appreciate your good wishes. And, long may these results continue. Look, the Reserve Bank of India order obviously has had an impact on both our franchise, our reputation, which, obviously doesn't feel good. And like I said, totally and utterly committed to coming back. That's our number 1 priority. There will be a period when we won't be able to issue credit cards and we won't be able to do customer onboarding using online and mobile channels. Obviously, the credit card business will be affected. And I think the other business that will get affected is our 811, which is a very, very important business for us. We want to utilize this period to actually focus on our existing customers and enrich the experience and hopefully deepen the relationship with the customers. And if we are able to do that, And if we're able to fix the technology and get it to the expectations of the RBI, I think we'll come out stronger on both fronts. If we're able to do all of this, frankly, I'm more worried about the reputational impact than I am about the financial impact. The financial impact in the scheme of things will be relatively small.
Okay, just one follow-up question regarding this. In the experience of past 2 weeks, have you seen any kind of trend as far as branches is concerned? Is there customers which you would onboard digitally are not there? Because you mentioned last time in the investor presentation, it was 90% of the customers were there through digital channels. So what has been the experience so far, and what are the steps you have already taken?
So if I may answer that question, we said 98% of customer transactions from savings customers goes through digitally. There is no impact whatsoever of our existing customers doing transactions through any channel, physical, mobile, net, or any restrictions on us cross-selling product through digital channels. For example, our term deposits, our personal loans, a lot of our products of existing customers where we put up pre-approved orders comes through digital channels. So there is no bar on existing customers at all, and hence that impact does not arise. And the two businesses that Ashok talked about, where we have very large bases of customers, say the 811, where our focus will be cross-sell till such time we work very hard with the regulator to make a comeback.
Thank you. Let's move on to the next question, please.
Hello. Thank you for having us here. This is Astha Chopra from ET Now. So recently Kotak said that they will boost their IT system. What timeline can we expect that they will mitigate the infra lags?
Sorry, I didn't get that.
I think the question is timeline for resolution.
So I think you should break that question into two parts, right? Number one is how long will it take us to get kind of ready to go? And then, of course, the RBI has required us to get an external auditor. The auditor will obviously look at it, confirm it, give it to the RBI, and then the RBI will kind of approve. Look, we are going to just double up and put far more efforts, far more resources, far more money into moving this thing as fast as possible, right? At what stage, we get... This is not like unfortunately, it's not like an exam where with multiple questions, where if you say, okay, give me these 4 answers, if I tick these 4 answers, everything is done. Technology is a little more complex than that. And at what stage we feel confident to go back to the RBI and say, look, everything that you've said is done, is of course one element. We will continue to assess that. I'm going to try and do that as fast as possible. But it will take, it's not going to be tomorrow. It's going to take a couple of months.
Hi, this is Mayur Shetty from the Times of India here. Hi.
One at a time, please. Can we just... Sorry, you need a microphone, please. And if you're ET Now again? No, sorry, we need to move on to another publication. We'll come back to you.
Hi, this is Mayur Shetty from Times of India. My question was whether this... back here.
Yes, Mayur.
My question was whether this RBI directive came as a bolt from the blue, or had you all started addressing some of these issues raised by the central bank earlier? Because in other cases like Bajaj Finance, they managed to kind of get out of it quite early because there was some conversation with the central bank before the whole thing happened. So has there been some similar conversation here?
Oh, like I mentioned to you, we've been at this for about 2 years. And if you literally look at our investor deck, every quarter we've been reporting out kind of progress. We've made a lot of senior hires. We've talked a lot publicly about the senior hires that we've made, augmented the teams, and obviously been in constant communication with the RBI. So this is not a new thing. This is about investing. Now, also the demand side is going up quite aggressively. You can just see how UPI transactions are going through the roof. More and more customers doing more and more things on the mobile, on the internet. So while we are gearing up, let's say supply is going up, demand is going up as well. And we just got to double up and get even faster and even better in the next couple of months.
Thank you.
you didn't answer the question on impact on growth. Will it affect your liability growth?
It should have far less impact on liability growth. It's going to be more on the credit card and on 811. The rest of the business should largely be unaffected.
I just want to reiterate again, there's no bar on any acquisition through branches or even through assisted mode. Only online accounts that are not permitted.
Well, hi, this is Abhishek.
Sorry, one question at a time, please. We can't. If you have the microphone, please identify and go for it.
Yeah. Abhishek Kothari from CNBC-TV18. Right here. Okay. Question to Mr. Ashok. First quarter at the helm, you have really outperformed with respect to business momentum. Take a look at deposit growth. Any of your peers have not done that. And you have improved your net interest margin on a sequential basis despite the deposit growth that you have seen. So, outlook over the next 3 to 4 quarters with respect to what are the strategies in place for, healthy business momentum or, healthy going of Kotak Bank?
So first of all, I must give credit to the management team. Obviously, in the first 100 days, I can't take credit for all the fantastic work that has been done. We have a fabulous management team at Kotak. It's got a deep bench, and they all are very, very committed and tenured employees driving the kind of strategy. Right? We are going to continue. We're going to continue on our commitments. We're going to continue to seek growth. Yeah, obviously the RBI order will affect, like I said, some of our businesses. But we are committed to kind of growing it, and we are committed to putting plans in place that mitigate things like the RBI order. So and Devang is a tough guy. He keeps us on our toes and keeps us going. Hopefully we'll continue to grow at the same rates as we have been all this while ago.
Well, your credit to deposit ratio declined sharply on a sequential basis, right?
Yes.
Is it a cautious stance to lower the credit deposit ratio or look at outpacing deposits growth to advances growth?
Yes.
Let me answer that question. If you see the CD ratio at December was 88%, which is, you are right, it is now slipped to 83%, right? So I think this is this reduction is essentially due to the deposit inflow we saw in the month of March. But as you write, I think we will have challenge to maintain at that level. But I think as the balance sheet grows, we expect the CD ratio also to be in the range of 86 to 87%, which was the annual average for the last year. Yeah.
Thank you.
Thank you.
Thank you, Abhishek. Let's move on to the
Ms.
second
Vaswani,
row here. We have someone with a mic, and then the ladies on the front row, please.
Ms. Vaswani, this is Vishwanath from...
We'll come back.
Vishwanath from NDTV Profit.
Next
Just,
up.
one question was with regard to your numbers, which is 1455 crore worth of retail unsecured loan write-offs that you have specified in your results. Considering the state of your overall NPA book and even your unsecured book, that's still a significant portion of it. I just want to understand behind this write-off, is there a clear strategy of pushing that down? Obviously, on the credit card side, you have other problems. But are you slowing down on the unsecured portfolio? And the second part, you've had a senior management member exit just this week. I wanted to understand what went behind the whole process, because you had elevated him only about 2 months ago, and then suddenly the exit within a 30-minute board meeting and with immediate effect. It seems a bit fast.
I'll take the unsecured credit card write-off or unsecured loan write-off question. So let me explain. I think unsecured book as a policy, we provide 100% provision as soon as they became 180-day overdue. So any unsecured loan which is 180-day overdue gets fully provided. We obviously continue to make efforts for collection, just because provisioning is accounting. But we continue to make efforts for recovery and put pressure on the collection and recovery by retaining in the book, so that there is a pressure for maximizing the collection. And after that, of course, once we realize that, beyond this, it is the chances of recovery are remote, we do an assessment and we write off. So this write-off is as a part of the normal process we do. And as you know, the unsecured loan book has grown over last years, and it continues to grow. And I think we have also already highlighted our aspiration to be in mid-teens, to be unsecured portion. So we'll continue to grow that. This write-off has no impact whatsoever on our growth aspiration as long as also on the profit for the year. There is no impact.
Yeah, I just want to add one thing to that. This actually will bring us in alignment with industry practice. We were actually not writing off for a very long time while the industry writes off at 180 plus 1 quarter. This will help us align with the industry. So it is simply that, and it's all provided for. As far as Manian is concerned, he was an amazing and wonderful colleague. He has contributed enormously to the building of this institution for the last 29 years as a part of the team. But as you may have read in his letter, he wished to pursue other opportunities in the financial services sector. So I guess, we only wish him well.
Thank you.
So, look, like I said, I completely agree with Shanti. I got to know Manian over the last couple of 4 months, obviously worked very closely with him. He's a very bright guy, and, honestly, I completely echo what Shanti said. He's been with Kotak a long period of time. He's built a fantastic business, part of that team. Manian had aspirations, right? Like you have, like I have, and wanted to pursue other opportunities. Now, he wanted to do that in the financial services sector, which obviously make it, a little more difficult, right? From just a timing perspective. So, he very rightfully said, I want to pursue these opportunities. I want to be upfront with you. And we said, that's fine. Sincerely wish you all the best. And we remain friends. I mean, because he's joining, because he wants to do something in financial services, then it becomes a little uncomfortable.
Does the bank have a gardening period or something like that before taking up another offer? This is just out of curiosity.
Sorry, can you say that again?
Gardening months or something like that before someone takes another opportunity in the FS sector?
So, frankly, I don't even know, because he doesn't, Manian, at least to the best of my knowledge, doesn't have something in his hand right now. Okay. Right? To the best of my knowledge. Obviously, you'll have to ask Manian that question. But I'm not aware of anything he has. And look, he's somebody who's been with the company a long period of time. He's a friend. Right? And so we really wish him the best, and, what happens with him.
I have a couple of questions on your numbers. This quarter, PAT growth was about 18%.
Can you please identify yourself?
Sure. I'm Hamsini. I work with a Hindu business line. My PAT growth was the PAT growth for the bank was about 18%. This is slightly slower compared to the past run rates that we've seen, including in Q3 when it was 30%. Your provisioning costs have gone up. Your cost to income is slightly higher compared to what it was last year. NIMs are also a little off compared to a YOY basis. Is there something about numbers that were a little slow this quarter, or that didn't pan out the way it normally would?
No, see, I don't know where you are getting
your
this.
Presentation, sir. Slide 6. Standalone financials.
Okay, let me just check. Yes, so you are referring to?
Slide 6.
Yes.
Q4 FY24.
Mm-hmm. So if I read Q4 FY24, our PAT growth is about 18%, right? And for the full year, it is 26%, right? So I think you need to understand the Q4 of last year, if I go through, which was the peak, where our NIMs were at 5.75%, the highest NIM, right? Which has come down to 5.28%. So one of the reasons, obviously, you are comparing a quarter which was a bumper quarter last year, right? So despite that, we have achieved a growth of 18% on that, actually. So actually, it is something, the credit cost, as you know, in the last year was also a very unrealistic level. If you see, the credit cost was about 13 to 15 bips. And, we used to call it as a Goldilocks period, if you recall. So I think what we are seeing is now the normalization, right? So despite that, if I again say, with a record quarter last year, we have still shown a growth of 18% over that.
Thank you.
Okay, I have just a follow-up on this IT issue. Mr. Vaswani, this is to you. Was it a little bit of a shock for you to see on that order that the bank has been in violation from FY22 and, CY22 and 23? How did you interact with the teams internally on this, and what was the feedback that you got?
So, right from the day I joined, I've been trying to get familiar with all the businesses and all the functions. I've spent a lot of time on the technology side, understood where we are going with the technology, what plans they have in place. So where we are, I had a very good understanding. I didn't need the order to tell me where we are, right? I think what this has got my mind really focused on is how can I speed up, what does it take to really speed up our plans? How do we accelerate our plans to get to, in a way, nirvana, and really get out and get Kotak back to business as usual.
Thank you. Let me just post one question from Ritu Singh, who's online from CNBC Awas. One question which remains unanswered. While tech spends are at 10% now, will these increase significantly going ahead, given the RBI's observations?
I think, yes, we have been spending 10% on an increased cost of operations, right? So our total operating cost itself increased by 20% over a year. Of that, the 10%. So actually that increase in the tech expense is already built into that. But based on, the progress of this resolution and the response to the RBI, we do expect some reprioritization of the technology spend, maybe slightly some upfront, some costs we will have to incur towards that.
Hi, sir.
Sorry, one at a time, please. Hi. Let's go back to the order.
Yeah, hi.
Let's just go.
Yes,
we'll come back to you. We have some time.
Yeah, hi. Thank you. I am Pragati Oberoi from NDTV Profit. I have two questions. One, as a follow-up on the management front. As of now, the portfolios that Mr. Manian was handling have been divided between Shanti Ma'am, you, and Mr. Vaswani, you. Is that a temporary fix? Okay, but going ahead, are you planning to elevate internal people or hire people externally for that? And how long is this temporary fix expected to last? That is my one question. Second is on the credit cards front. Any details as to what were the problems raised by the RBI? Was it just with the co-branded partnerships or other issues as well? Any tech issues with the back-end, API integration? If you could help us understand, please.
So, coming to your first point, when Shanti and I wrote the memo about the reorganization, I don't think there is a single word there called temporary. This is, look, at Kotak, the good news at Kotak is that we have good bench strength, right? Clearly, Devang is a classic case of that, right? Shanti is there. Now I'm on the board. You saw that we got Jaideep, and Jaideep was, again, an internal candidate we brought up. At every point in time, there will be people who will retire. There will be people who will take on new opportunities. And at every point in time, we think about who is the internal successors. One of the first things I did was evaluate the people and say, where do we have the gaps, where we don't have the gaps, where can we move people around, and things like that. So people is an ongoing conversation. It's not an event. Nothing is temporary. I have not issued this, nor has Shanti issued this memo saying we're temporary. This is how we'll run the business, right? And we'll see how the business evolves, and then we'll see what happens. And then we'll man the business appropriately for talent. As far as your question on credit cards is concerned, look, credit cards is a business that is growing pretty quickly. It's growing pretty fast. And I think from an RBI perspective, that growth is something they said, does that put a kind of constraint on the system, right? This has got nothing to do with co-branded cards. They haven't said you can't do co-branded cards. They basically said don't issue fresh credit cards, right? And our credit card business runs on an external platform, Vision Plus. Vision Plus is an international platform. And then, of course, Vision Plus is connected to Visa. We are a Visa issuer. And that only does direct reporting and GL posting. So credit card, frankly, is a pretty standalone kind of operation.
Sorry, a little confusion there, sir. Can the growth be expected from co-branded credit card partnerships?
No, the RBI has not done. The RBI is not saying don't do co-brand or proprietary or whatever. The RBI has basically said cease issuing fresh credit cards. So co-brands have got nothing to do with this. It's just we'll have to stop all new credit cards.
I just want to add to what Ashok said on the first point. Each of those businesses that we have sort of divided amongst ourselves run by very strong leaders who've been there for a very long time and have really built those businesses. So I just wanted to make that.
Thank you, Shanti. Let's go to the next one, please.
This is Abhijit Lele from Business Standard. One is with regard to the in the industry, there has been quite a surge in the attrition rates at various levels, at least in the middle and the lower ranks. Since you have come as a fresh, do you have any specific plans? How do you need to address this? That's one part.
I'll answer that and maybe you can support since he's asked you specifically. So firstly, as far as Kotak is concerned, and we had said this last year as well, bulk of the attrition is at the entry level and feet on street. At that level, youngsters of today have a very different view of life and want in life. So the real thing is that how do you keep that force motivated? Because they get a lot of opportunity. At that level, an increase of 15,000 means a lot, right? And instill into them training so that they can move up the career fast. Okay? So I think the attrition is really at the feet on street and the junior level, and we have done a lot of interventions, right, over the course of the last 7 odd months, 6 to 7 months, to really address that. Having said that, the demand supply in the industry, right, is pretty high. And it's not just banks, it's banks, non-banks, Swiggy, Zomato, sorry to say this, the industry at that level is pretty wide and diverse. And you have to keep investing in them and keep motivating them and making them feel fulfilled. But attrition will be for real higher than maybe at the senior level.
The second question is about reprioritizing on the credit various businesses. Is there going to be reprioritization given the changing economic environment as well as the RBI impact?
So let me take both the businesses, 811. We have a large base of customers. The reprioritization is really how do you go deep? How do you cross-sell products to those customers? How do you make the journeys so that when we come back, how do you build different products? So it is really about using this time to go deep into your customer. It's very much the same with credit cards. We have a large portfolio, right, of existing customers. How do you sort of grow those customers? How do you increase the spends? And related products like personal loans, etc., where we will be putting more emphasis because we have some feet on street. So absolutely right. We will make sure we use our staff very productively.
Thank you.
All right, so that was the Kotak Mahindra Bank management addressing the media after their fourth quarter earnings, a beat on the profits and the net interest income. But some of the key highlights, apart from the numbers coming out from that press conference, firstly on the curbs imposed by RBI on their credit card business and the onboarding of customers digitally. The bank said that even though they've been spending nearly 10% of the OPEX on technology spends, it seems to have fallen short of what the regulator expected. And going ahead, these spends will continue to increase. They're working very closely with the regulator to strengthen the IT infrastructure of the bank. Importantly, the new CEO, Ashok Vaswani, outlining his strategy for Kotak Mahindra Bank, a new CEO taking over, after Uday Kotak, the long-time CEO, stepping down. And he said that the direction is pretty clear, that they will work on a 4C framework for the bank. And that includes the customers, the colleague, that is the talent, the company and the community, which includes the regulator. He said that the team is very clear. The top priority, the number one priority for Kotak Mahindra Bank at this point of time is to get it back to business as usual, and that when the curbs are lifted by the regulator, Kotak Mahindra Bank will come back roaring. Besides this, of course, on the big topic of their joint MD and whole-time director KVS Manian exiting from Kotak Mahindra Bank, importantly, you had Ashok Vaswani saying that to the best of his knowledge, KVS Manian did not have any offer in his hand. He also seemed to indicate that he seemed to want to pursue some opportunities in the financial services space, which is why he did not serve any notice period and was asked to leave within immediate effect. So that is, some of the key highlights from the Kotak Mahindra press conference. Of course, apart from the financial numbers, which, as I said, have been strong, advances have been strong, deposit growth very good, much better than some of their peers, margins also quite stable for the banks. So that is as far as Kotak Mahindra Bank's fourth quarter numbers are concerned. We are going to have to take a very short break on that note, but don't go anywhere. We're back with more news and updates in just a jiffy. And here's some important news that we've been tracking for you. The government has announced the removal of restrictions on onion exports. What does that mean and what are the significant takeaways from that? My colleague Abhimanyu Sharma has been tracking that story and joins in to fill us in. Abhimanyu.
Well, government officials have indicated that the recent decision to reallow export of onions is based on the harvest season, the quality of the crop, and the domestic market prices, and not the dates of any election. They categorically denied that this was somehow related to the ongoing elections and the particular phases which are taking place in Maharashtra, where there has been a continuing demand from farmers to remove the export ban. Also, the officials have assured that the decisions which were taken by the government's interministerial committee should not be looked at in isolation, and they may be reviewed in near future if at all need arises. India has allowed this export of onions from the 4th of May, which is subject to a minimum export price of $550 per ton, 40% duty. Now, that currently is applicable, and as per government, the average price at which onions are being exported is between $550 to $600 per ton. And also the decision took into account the estimated Rabi season production in 2024, as well as the good prospect of the Kharif crop. Officials have also indicated that the onion prices at the Lasalgaon Mandi in Maharashtra have remained largely stable at rupees 15 per kg in the past few months, and they have even slid further after the ban on exports has been lifted. So it clearly remains to be seen how the situation is going to pan out in the days to come, since the government has also added that onions cannot be stored beyond the shelf life of 4 to 6 months. And India's average monthly consumption of onions is 17 lakh metric tons. So that's something which the government is looking at, even as the government is going to possibly build a buffer stock, which usually it builds. And for now, this decision is aimed at not just ensuring ample availability within India, but also ensuring benefit of the exporters, of the farmers who may possibly fetch better prices in international markets.
All right, Abhimanyu, thank you very much for bringing us that update. All restrictions on onion exports have been removed. with effect from today. Now moving on, let's get you some excerpts from our conversation with Friday's big news maker, Rajiv Bajaj. Now Bajaj Auto is powering up its product pipeline with the launch of its most powerful Pulsar, yet at an introductory price of 1.85 lakh rupees. Speaking exclusively to CNBC-TV18, Managing Director Rajiv Bajaj said that the company will launch a new sub-1 lakh rupee electric scooter this month. He also said that Bajaj Auto plans to launch more vehicles under the EV portfolio, adding that the company will be rolling out its e-rickshaw very soon.
There will always be a better Pulsar. Very often than not, it means a bigger Pulsar. 50% of Royal Enfield, which would be about 35% or so of the market, maybe a little more. Hopefully in 6 months' time, it will take that much time to rev up production for this particular motorcycle. Our capacity is 40,000 a month, roughly 500,000 a year. As we begin to approach this capacity in 6 months' time, then we will review the need to expand.
All right, so from the auto space, we're going to shift focus to the aviation sector now, where Go First's grounding has completed 1 year. The resolution process has been underway for 12 months, but there was no visible progress other than the bids submitted by the two bidders a couple of months back. Industry experts feel the airline will most likely move towards liquidation, or the next step has to be seen depending on what the creditors decide. Madiha Mujawar recaps the tumultuous year for the airline and its various stakeholders. Madiha, over to you.
Well, the Delhi High Court's order on 26th April changed things drastically for Go First's revival. The court had ordered the aviation regulator DGCA to deregister all 54 leased aircraft that the airline had taken from various lessors. And this week, the DGC abided by that order, deregistering all the planes. So currently, the airline has no aircraft and also hardly has any employees. Now, most senior executives had quit months after the grounding when hopes of a revival had started to fade. The CEO Kaushik Khona had stepped down in November last year, and he had said that non-payment of salaries and the resolution professionals' failure to revive the airline has led him to resign. The two bidders, Busy Bee, Ajay Singh Consortium and Sharjah-based Skywind, had submitted their bids in February. Now, will it make sense for them to buy an airline that has no aircraft and huge liabilities? That's the big question. And while Skywind is already a leasing company and could possibly arrange aircraft if it were to take over the airline, how will the Ajay Singh Busy Bee Consortium revive an airline that has no planes? Now, management consultancy firm Primus Partners told CNBC-TV18 that minus the planes, the valuations given the liabilities will not be worth the effort for anyone interested in reviving the business. It added that there was a difference in valuation expectation between lenders and bidders even with the planes on the table. It further said that the key value is in land, slots and Pratt & Whitney engine arbitration case, which the creditors can realize themselves using liquidation proceedings and may not require a resolution. So the long stretch process which saw the NCLT extending deadlines 3 times has not yielded anything so far. Lessors did win the case after months of losses from unutilized planes, but do they get to fly the aircraft abroad, and are the planes in a condition to be flown after staying grounded for several months? The last 1 year has kept several employees, vendors, travel agents and passengers hoping for the airline's revival, and as things stand, a revival looks quite unlikely.
Well, a question mark on Go First's revival. Madiha, thank you very much for bringing us that story. On that note, we're going to wrap up this special show. Thank you very much for watching, but stay with CNBC-TV18 for more news and updates.